Welcome to this explainer. Look, today we're unpacking something literally all of us have to deal with. But let's be honest, we all kind of dread it. It's the taxpayer's journey. Whether you're navigating complex income tax cases or trying to keep up with GST compliance, understanding this entire life cycle, from your very first filing all the way up to landmark appellate rulings, is absolutely crucial. So let's dive in and make some sense of the legal frameworks governing our accounting and financial lives. So what happens when your tax return goes wrong? Just imagine this absolute nightmare scenario. You file your return, you're thinking everything is perfectly aligned with your books of accounts, right? But then, bam, a tiny, simple arithmetical mistake, maybe just one mismatched invoice, and suddenly you're spiraling into a wildly stressful, time-consuming legal dispute with the tax authorities. It is honestly crazy how fast a tiny oversight can trigger a massive headache. Nobody wants to be there, but knowing exactly how the system works is, without a doubt, your best defense. Okay, let's look at the roadmap for today. We'll be covering filing returns and common errors, then we'll get into maintaining your books of accounts, responding to tax notices, navigating the appeals process, and finally, we'll wrap up with some landmark cases and rulings. Part 1. Filing returns and common errors. Let's tackle this very first hurdle. Now, a return can go sideways in a few different ways, depending on the exact tax regime we're talking about. Under the Income Tax Act, for instance, if your return is flagged as a defective return, you are handed a very strict 15-day window to rectify those income tax return errors. If you miss that window, well, the law treats it as an invalid return. Literally, it's as if you never even filed the thing. On the GST side of things, modern digital compliance is basically a minefield. A simple GST return error, like a mismatch in your e-invoices or a missing e-way bill, can instantly render a return invalid, which completely freezes your flow of input tax credit. The really crucial takeaway here is understanding the real-world impact of automatic adjustments under Section 270. It's not just deliberate evasion that gets you in trouble. Simple, honest mistakes catch taxpayers out every single day. We're talking about basic arithmetical errors, trying to claim a loss too late, or even just inconsistencies with the pre-filled data the government already has on you, like your Form 26AS. But here's the silver lining. The authorities can't just secretly alter your tax bill in the dark. The law actually mandates that they must issue an intimation first, giving you a fair chance to respond. Moving on to Part 2, maintaining books of accounts. This right here is the absolute foundation of your compliance. And this brilliantly illustrates the sheer power granted to tax authorities. Under Section 269, a valuation officer can legally enter your premises, inspect any asset, and aggressively compel you to produce your books of accounts and other documents. If your accounting is messy, incomplete, or if you're missing crucial billing details, you are immediately vulnerable when they apply this level of scrutiny. Believe me, meticulously kept books are pretty much your only shield. And the consequences of sloppy record-keeping are genuinely severe. Under Section 271, penalties are triggered specifically if you fail to record any receipt or investment in your books of account that might impact your total income. Here's the truly scary part about this. If you hide a receipt from your books, the law just assumes a deliberate intent to evade. They aren't going to look at it as a harmless typo. They assume you're guilty of evasion, and let me tell you, those financial penalties are incredibly punishing. All right, Section 3, responding to tax notices. This is where we overcome the obstacle. So today, the whole assessment process is heavily digitized through the National Faceless Assessment Center. When a notice or intimation is actually served, which is usually electronically via your registered account or email, a ticking clock immediately starts. Step 2, you typically have a strict, totally non-negotiable 30-day window to get your notices reply and supporting documents submitted. Then in Step 3, your reply goes right into the faceless system, which routes it directly to a specific assessment unit. Missing this 30-day window? Yeah, that can lead to adverse adjustments being made entirely without your input. No way you want that. It is also super vital to understand the time frame authorities have to actually issue these notices. These are known as sunset clauses. Under GST, for your normal run-of-the-mill GST cases, they have 3 years from the annual return filing date to issue an adjudication order. But if they even suspect fraud, willful misstatement, or some sort of deliberate suppression of facts, that window jumps straight to 5 years. 5 whole years. That is a really long time to have a target on your back for some old mistake. Which brings us to Section 4, navigating the appeals process. What to do when you need to seek justice. When we look at the official income tax appellate structure, you basically move from the Commissioner of Appeals up to the tribunal and then eventually to the High Court if there happens to be a substantial question of law. But here is a super surprising and honestly harsh fact about this legal system that trips so many people up. You literally have to play. The law explicitly states that no appeal shall be filed unless the admitted tax is paid to the credit of the central government first. You simply cannot file an appeal just to delay paying what you already admit you owe. And remember, this whole thing runs on compounding, incredibly rigid deadlines. You have just 15 days to rectify a defective return. Boom. If you get a demand notice, you generally have 30 days to file an appeal with the commissioner. Boom. If you're escalating a decision to the National Tax Tribunal, you have exactly 120 days. The pacing is absolutely relentless. Missing any of these statutory dates doesn't just, delay your case, it can permanently cost you your legal right to appeal entirely. Finally, Section 5, Landmark Cases and Rulings. Let's see how all this law plays out in reality. Now, what's really interesting here is seeing how a few major Supreme Court cases fundamentally shaped the rules that we all play by today. For example, in the cross-border taxation space, the Vodafone case reinforced the absolute sanctity of double taxation avoidance agreements. That was a massive win for international investments. Then you have McDowell & Co., which established really firm, uncrossable lines against sham transactions that were just disguised as clever tax planning. But honestly, perhaps the most frequently cited ruling in day-to-day income tax cases and assessments is Durga Prasad Moore. That specific case cemented what we call the substance over form doctrine. You can kind of think of it as tax authorities having legal X-ray vision. What it means is that they aren't blind to creative accounting. They can and absolutely will look straight past your perfectly formatted paper agreements and your meticulously balanced books to examine the actual, real-world reality of a transaction. If the underlying reality is just a sham to evade tax, your perfectly crafted paper trail will absolutely not save you. So that brings us to the ultimate question you really need to ask yourself today. Are your books of accounts, your e-invoices, and your tax returns truly ready to survive a faceless assessment right now? Don't just sit around and wait for a 30-day notice to find out. Proactively audit your own compliance, respect those aggressively taking timelines, and make absolutely sure the substance of your business always matches your filings. Thanks so much for going on this journey with me, and I'll catch you on the next Explainer.